Welcome back to the Up-Level Dairy Podcast. I'm your host, Peggy Coffeen, and in this June monthly market update from HighGround Dairy, Curtis Bosma joins us to give a report from what he's seen in the dairy market, looking at strong cheese and butter production as well as rising domestic demand and favorable export conditions. You're going to hear what's coming into play as those federal milk marketing order changes are coming into effect for producers and how that looks on their milk checks, as well as how the feed market is being impacted by corn and soybean meal dynamics, including biofuel policy, and rounding out the discussion today with those fluctuations in the feeder cattle market and why dairy producers may want to consider looking at some of the options available to them with livestock risk protection programs for their dairies. This episode is brought to you by HighGround Dairy. HighGround Dairy provides global dairy market intelligence, insurance services, futures and options brokerage, and advisory programs to a diverse range of dairy market participants throughout the supply chain. Information in this podcast is for educational purposes and is not a solicitation to buy or sell commodities. Opinions expressed are current as of June 18th, 2025 at 1 p.m. Central Standard Time and only represent the views of the speaker and not those of HighGround Trading unless otherwise expressly noted. Now let's hear from Curtis Bosma with HighGround Dairy. Curtis, welcome back for our monthly market update from HighGround Dairy, and we are in June already, halfway through 2025. Give us the update on what's been going on in the markets in the past month.
Yeah, June is Dairy Month, and it's an exciting month to be watching all sorts of markets right now. So we'll run through a little bit of milk, a little bit of feed, and even talk cattle today, since that's been an exciting market to follow as well. Looking at the milk side of things, cheese and butter have really been the big stories. Those make up the bulk of the value in most producer milk checks. We saw some nice support as cheese prices moved up into that 190 range over the last 2 months or so. We ran into some resistance there in late May, early June. We've started to move lower a little bit there. The main story there has been on the demand side. Exports have been solid. We've been still pricing at a discount comparatively to the rest of the world. On a dollars per pound basis, European cheese and other export regions as well are in that $2 plus to $2.20 in some cases. That would be on a cheddar equivalent. And at us being at a discount here in the US, we've been able to secure a good amount of export business moving forward here. Another thing is cheese stocks. We whittled them down a lot throughout last calendar year. We've been slowly rebuilding them. But I think what really stuck out from the data over the last month is the April USDA Dairy Products Report did show us that cheese production, total cheese across the US, was the highest that it's ever been historically. It's a pretty significant jump up on that chart from a cheese production month to month, which is really no surprise given what we've seen with all the investments being made specifically in Class 3 processing assets across the U.S. But now as those plants are coming online, as that cheese is getting made, we're in a position now where those stocks can quickly be rebuilt. I also think it's worthwhile mentioning we have seen some economic, I would say, improvements, but still there's a lot of crazy headlines. Depending on which news source you're subscribing to, we're either entering World War III right now or we're seeing one of the craziest technological stock market runs of all time. But still over 90% of our US cheese consumption is domestic. And so if there's any slip up in restaurant traffic or anything like that, that significantly will impact our ability to move product through the system. On the butter side of things, similar story to cheese, where our U.S. butter prices have been at a low enough price point comparatively to the rest of the world to continue that export demand, keep a certain level of buoyancy in that market. We have started to see some nice kind of recovery as we enter into the late spring, early summer months here. Butter found its footing and has been moving upward here. We were sitting at that sort of 250 level for a little while, which is right around a 3-year low, but we've been climbing away from that price point. Big thing there is, domestic demand has been very strong. Again, that's not a new trend. That's just more of a continuation of butter having this demand and elasticity where we can't replace it. It has to be something that people now that seed oils are pretty bad and butter is pretty great. So that's been something to be mindful of here. But I think the big thing to watch for specifically on butter as we get to the end of the Q3 kind of purchasing cycle, which is where we start to see a lot of the holiday orders come in, is that going to be strong enough to get us up to one of those higher price point levels again? Or are we going to just maintain this soft rally, I guess is one way of putting it. But yeah, overall, I think milk checks have still been looking good. Margins have been looking good for producers in these scenarios. I think the other big thing to call out specifically for the month of June is this is the first month that the changes to the federal milk marketing orders have been enacted. And so there may be some little bit of differences that producers may notice in their milk checks when looking at the relative value of where cheese and butter and other commodities are compared to the component values, because as we know, one of the first big changes that is going to be impacting producers is the increased make allowances, which will reduce the component values relative to the commodity price values coming from both cheese, butter, and everything across the board there. So yeah, that'll be a pretty significant decrease, at least initially, in producer milk checks. Looking at where things are at right now, there still are some pretty good prices on the board for producers to be working with.
So Curtis, I want to just pause right where we are at for a moment here because of the timeliness of this topic. Of what we've been talking about for a good year straight is the FMMO changes. And now we are in the stage of actual implementation and feeling it at the producer level, seeing it on the milk check. And so when you talk about some of the ways that is showing up in the mailbox, what are you seeing specifically? Who's impacted the most regionally by those changes in make allowance and how that has impacted that mailbox price? And what are you seeing in the difference between what they would have been receiving in the past and what they're getting today?
It's kind of a widespread impact. All producers that are priced off the federal milk marketing order, which I would say all producers that are priced off the federal milk marketing order, which I would changes. So it may not be a immediate noticeable difference because we still are at a price point to where getting $18, $19 class 3 and class 4 milk historically is still a good price point to be at. But when you do run the math and run the numbers of, hey, what could this have been if make allowances weren't increased? Well, then, yeah, maybe things could have been better. But you kind of have to also look back historically, and you could make the argument that a lot of this investment in dairy processing capacity in the U.S. would not be taking place if it was not for these amendments to the federal milk marketing order. So it's a little bit of a double-edged sword there of, I know speaking to farmers all day is everybody wants to grow their farm and make sure that their legacy is the most profitable and bountiful for what they can do for their family and community. But throughout the supply chain, there needs to be some semblance of a margin existing, the wheels to remain in motion.
Yeah, well, thank you for giving us some insight into how those FMMO changes that we have been discussing here on Up Level Dairy podcast for well over a year and in every other dairy media outlet, how they're really coming into play today, but also how they might look in the future. What else are you seeing from movements in the market and things that are going on that are impacting dairy producers and affecting their bottom line, Curtis?
Yeah, so shifting gears a little bit over to the feed side of things, looking at primarily the two markets we're focused on for dairy producers is corn and soybean meal. On the corn side of things, the last WASDE report showing us where things were at globally was not all that surprising. Old crop stocks of corn were tightened up a little bit on increased export expectations, which, as we've seen export sales week to week, is not all that surprising to see that going. Mexico's been a key buyer of our U.S. corn, and that has continued to keep that market at least a little bit supported here. But when you look globally, it's an interesting thing. You look globally at the corn market and you look at where global stocks are compared to what global usage is, and this is taking full scope of what the inventories are globally and looking at production in South America and all over. We're still in a situation right now where we're historically a little bit on the tight side. But when you look at the futures markets here in the U.S. for our domestic corn prices, we have failed to really launch or move higher on any of those tighter balance sheets. And a lot of that has just been based on the sentiment about how large our current crop that's in the ground is going to be. When we start throwing around some of these 95 plus million acre planting intentions and the potential for yields at 180 per bushel per acre as an average for the total US, weather has been cooperating. All of those headlines, at least in the short run, have provided us with a typical weather market where sellers have been active and been keeping that market relatively suppressed. But when you do zoom out and look at those global balance sheets, there is the potential that hiccups in US weather or changes in trade policy or something could potentially put us in a situation where that corn market could start to get a little bit running away from us. And that's been something, looking at this, I think from an overall margin perspective for the dairy producer, has been, hey, when we look out, we have pretty good milk prices going out into 2026 at the moment, especially comparatively to where futures are for feed at the moment. But then when you're looking at cash market offers and bids for what you can get corn delivered to your dairy for, and there's a pretty significant carry. If you're on a spot contract and you're looking at what you're getting now for your price versus what you would have to pay to secure a longer term contract, a lot of people look at that and say, hey, well, I'm not going to agree to the longer term deal where I have to pay up and pay for the carry in that market. And that's where we really start to take a look at some more of these serious strategies where we're adding some flexibility, where we might be putting in some form of a price ceiling using futures and options, some sort of a collar strategy. Those are things we've been exploring a lot lately with clients, just because if there is a situation where the global corn balance sheet is tight enough for that market to run away, we want to make sure we have some flexible price protection so that, hey, if the US crop is indeed huge and we do see more downside pressure that's going to eliminate some of that carry going out into the future, well, then let's not worry about it. But our crystal ball is wrong probably more than it's right sometimes. And we want to make sure that, hey, if this thing gets away from us, we have some protection, because at the moment, the projected margin going out into 2026 is quite favorable. And we're in a situation to be able to seize that opportunity and remain flexible if conditions change.
So moral of the story there, Curtis, is what you're doing is helping producers have that flexibility to be able to take advantage of commodities and where they're at, but also have some protections in place so that they have that agility to change a little bit on the fly and not be locked in should things change and shift based on what else is going on around the world in the next few months.
Absolutely. It's all about having flexibility in these sorts of things. And we're actually having similar conversations right now around the protein side of things. So on soybean meal, the big headlines there as of late have been the EPA proposing new targets for fuel blending. And so if those targets are higher for biofuel usage and biofuel production here in the US, that is somewhat supportive to the soybean market, and particularly the soybean oil market. But it's actually going to continue to support our domestic crushing industry. So for the soybean meal, being the byproduct of soybeans being converted into oil, that's actually a little bit bearish. So the soybean meal market has been selling off and riding at some historical lows here as of late. And so similar conversations are happening there where, hey, if we look at our corn usage, our soybean meal usage, and our milk price going out into 2026 right now, the numbers look pretty good. But if we're going to get these lofty biofuel targets in production and we're going to be crushing all these beans domestically and that price does move down, as the producer, you don't want to necessarily agree to paying in the carry of an extra $20 a ton going out that far. So it's a good idea to keep that flexibility in the strategy, and that's been something that we've been evaluating very closely.
And you talk about soybeans and biofuels, but corn ethanol?
Similar thing. It's a pretty big usage area on the corn side as well. So as we are looking down some of those things, especially we've talked a lot about tariffs and trade wars and stuff on this podcast, some of these increased targets for how we use specifically corn and soybeans domestically, maybe that's a little bit of a concession to help us wade through some potentially complex trade negotiations. But at the moment, we can only really play the hand we've been dealt. And at the moment, where the futures markets are sitting, the producers have been dealt a pretty good hand, and we're just trying to make sure everybody stays in the driver's seat. Lastly, to cover cattle, it would be a shame if we didn't mention it, but in the month of June, we've officially brought feeder cattle to a new all-time high. We touched, what was it, about 315 per hundredweight. Amazing to see these price levels. Not really anything new in terms of market shifts or changes. Again, cattle inventory in the U.S. lowest it's been since the 1950s. So that's been something the entire industry has been watching here closely. With how expensive these feeders gotten, the day-old calf prices we've heard now in excess of $1,300 a head. It's something that now we're looking a lot more closely into with producers because there is a significant amount of value there. And with the new LRP updates that are going to be live as of next month, so coming July, we'll have the ability to secure the value of those day-old beef cross calves as well as your cull cows. So that's become a pretty significant portion of the overall revenue on dairy farms. Looking at income statements and financials from dairies, historically, maybe that was 5% of total revenue, but now that's getting closer to 15% on a lot of herds. So because that's become a significant portion of the herd inventory management and overall revenue strategy of a dairy farm, and we're at these record high price levels, being able to secure that going out into the future is something that a lot of producers are now looking into, because why wouldn't you in this market right now? It's great timing that we're being gifted these new tools at a time like this.
And speaking of these new tools with Livestock Risk Protection, LRP, this is a conversation that you and I are planning to actually get a little more in depth on in the next few weeks here, Curtis. And so for any of our listeners that have specific questions, I just want to make sure that we are extending the invitation to reach out to you or I with Peggy at upleveldairy.com, Curtis directly to you as well, links in the show notes there, because it's our goal to provide some real, tangible education on a topic that is new and that is big and broad, and still really looking at how can we look at livestock risk protection as a tool that dairy producers can have in their toolbox. And in this time, there's no time like now to step into what those tools are and how they can best be utilized. And so that's something that listeners can look forward to, is learning more about that. But also, if there's specific questions that you have, sending them in so that we can help to address those and get those answered for you here through Up Level Dairy Podcast.
Yeah, and if there's any thoughts people are having about these things, I know right now we're in the month of June still, so we're in that time frame where producers, if they have an existing policy for DRP or LRP with another agent or provider and are considering saying, hey, am I really getting what I should be out of these programs? Do I really feel like I have a strategic approach to how to use these tools for my dairy to navigate the markets going forward, particularly at a time like this where we're being presented with a really good opportunity? Reach out to us. We can definitely help you evaluate that and see if we'd be a good fit for helping you out going into the future.
Excellent. All right, Curtis, what else is on your list of things producers should be knowing about based on what you spend your time digging into and studying every day when it comes to markets and the movements?
I would say the biggest thing is just making sure that we all have a plan. We take a look at these markets, especially at a time like this where we sit here and we publish actually on a weekly basis for our email subscribers. They get every Monday morning, we send out a margin monitor. And essentially in that email, all we're doing is grabbing all of the details to get the average U.S. dairy herd on component production, milk utilization, feed utilization, all those things like that, so that we can look out into the future and just have this generalistic barometer that says, hey, based on where futures markets are at today, do dairy farmers have the opportunity of securing a profit margin, or what are we looking at here? And we track those on a quarterly basis over time. And when prices had dipped lower early on this year, we were looking at it and saying, oh man, Q2, Q3 may be a little bit tough, but now we're back. We have good numbers on the board. We've been able to secure some significant profits for clients going out through the end of this year. And now we're taking a good hard look at next year as well. And that's something for advisory clients of ours. We're really fine tuning those numbers to make sure that dairies are understanding based on their specific component production, based on how their milk is being priced through their cooperative or milk handler, that we have a strategy and we have tools in place. I mean, I got to learn this firsthand from coming from the dairy farm to then working in this side of the business and seeing how some of the biggest food companies in the world are navigating their commodity price risk management strategies. And they have systems for this, believe it or not. They look at how far out they should be budgeting, where markets are presenting opportunities comparative to their budget, and then they have essentially rule sets that say, hey, if we have an opportunity to secure a certain margin based on where we're budgeted, we're going to do so. And I think having those sorts of things to remove emotions from this are very helpful, because I think especially when you get into it, even if you're presented with this opportunity and when you're looking at our margin monitor and you see, hey, this is amazing, we can make $2 to $3 a hundredweight as a profit margin through the rest of this year. Well, emotionally, are you going to put the hurdle in front of yourself to allow yourself to secure that margin or take some of that risk off the table? Or are you going to wait till we get to $4 or $5? And I think at the end of the day, we can apply a lot of math and science to this exercise, but there's a lot of psychological battles that we're faced with in being able to actually take the actions necessary to make these things a reality.
And so, moral of the story there, have a plan that supports taking the emotion out of some of this major decision making. And Curtis, I want to give you just 1 minute to wrap up here. If you were to summarize everything that we've talked about in this June monthly market report today with one key message for dairy producers regarding how what's been going on in the marketplace is impacting the milk check that they are just about to receive, what would you tell them?
Before we head out for the lake house on the 4th of July and we have a really good time, let's make sure that we have our margins in check for the rest of this year and looking into 2026 as well, because we're in a good position right now moving forward as an industry. And I would hate for dairy producers to see these opportunities slip through their fingers and not be able to capitalize on some of the good things we have out in front of us.
Well, Curtis, thanks for jumping on with me today for our June monthly market update. And as usual, you can find more information from Curtis and HighGround Dairy in the show notes. And until next time, we'll be excited to reconnect with you in July. You've got fun things going on in your world. In fact, I think you're going to be adding one more member to the family in the next month, correct?
Yeah, we'll have an addition of a baby girl here coming very soon.
Excited to hear about the new addition to the family and wishing you all the best until we reconnect in July. Thank you so much, Curtis.
Yep, thank you.
You just heard from Curtis Bosma with HighGround Dairy here on the Up-Level Dairy Podcast. Make sure you check the link in our show notes if you'd like to reach out to Curtis or find some more information from HighGround Dairy. And until next time, I'm Peggy Coffeen. Keep on growing, keep on learning, and up-leveling your dairy.